A recent study by CoreLogic indicated that in volatile markets, the average gross profit margin for house flipping can plummet from over 30% to single digits, sometimes even negative, within a single quarter. This stark reality underscores a critical dilemma for many real estate entrepreneurs. How does one adapt when a once lucrative strategy like house flipping becomes a perilous gamble? We will explore the compelling transformation of Robert Lee, a seasoned investor who navigated the treacherous waters of the 2008 housing crisis, making a profound strategic pivot from quick turnaround house flipping to the enduring stability of long-term rental properties. This journey offers invaluable lessons in market adaptation, risk mitigation, and sustainable wealth building. Robert Lee began his real estate career with an aggressive focus on house flipping, a strategy that thrived in the booming pre-2008 market. His approach was straightforward: identify undervalued properties, execute rapid, cosmetic renovations, and sell quickly for substantial profits. For years, this model delivered impressive returns, fueled by readily available credit and an ever-appreciating housing market. He built a reputation for efficiency and keen market timing, often completing several projects simultaneously. The market conditions leading up to 2008 were characterized by speculative fervor and an optimistic belief in perpetual appreciation. Home prices across the United States saw unprecedented growth, with annual increases often exceeding 10% in many metropolitan areas. This environment, while seemingly robust, masked underlying fragilities, creating a perfect storm for investors who relied heavily on short-term gains and escalating property values. Then came the seismic shock of the 2008 housing crisis. As subprime mortgages collapsed and foreclosures surged, the market froze. Robert found himself in an unenviable position, holding a portfolio of properties that were rapidly depreciating in value, with buyers vanishing and credit markets seizing up. The very foundation of his house flipping business, rapid sales and appreciating assets, crumbled almost overnight. The financial repercussions were immediate and severe. Properties that were once projected to yield substantial profits now represented significant liabilities. Carrying costs, including mortgage payments, insurance, and utilities, began to erode his capital reserves. Robert faced the grim prospect of liquidating assets at a loss, a stark contrast to the quick gains he had grown accustomed to. This period demanded a radical reevaluation of his entire investment philosophy, moving beyond immediate profits to long-term resilience. This profound struggle forced Robert into a period of deep introspection regarding his investment principles. He recognized that his previous strategy, while profitable in an upward trajectory, lacked the inherent stability to withstand severe market contractions. The experience highlighted the critical difference between speculative gains and sustainable wealth creation. His mindset shifted from chasing rapid arbitrage to seeking enduring value and consistent income streams. His strategic pivot toward rental properties emerged from this crucible of financial pressure and philosophical reassessment. Instead of viewing distressed properties as immediate flip opportunities, Robert began to see them as potential long-term income generators. The objective shifted from capital appreciation alone to consistent cash flow and gradual equity buildup, a far more defensive strategy in a post-crisis landscape. However, the transition was not without its formidable challenges. The skill set required for house flipping, identifying renovation opportunities, managing contractors, and executing quick sales differed significantly from that needed for property management. Robert had to learn the intricacies of tenant screening, lease agreements, maintenance scheduling, and managing ongoing operational expenses, all while navigating a deeply uncertain economic environment. It was a complete overhaul of his operational framework. Robert's new acquisition strategy for rental properties became highly analytical, focusing on metrics crucial for long-term viability. He prioritized properties in stable neighborhoods with strong rental demand and favorable school districts, often targeting foreclosures or short sales. A key metric he adopted was the cap rate, or capitalization rate, which is the ratio of a property's net operating income to its current market value. This provided a clear, immediate indicator of a property's potential profitability as a rental, allowing for objective comparisons. Financing rental properties also presented a different set of considerations compared to bridge loans for flipping. Robert sought long-term conventional mortgages, often requiring a higher debt service coverage ratio or DSCR. The DSCR is a measure of the cash flow available to pay current debt obligations. A DSCR of 1.25, for instance, means the property's net operating income is 125% of its debt payments, indicating a healthy margin for investors. This approach ensured that each property could comfortably service its own debt, even with potential vacancies or unexpected expenses. To manage his growing portfolio, Robert implemented robust property management systems. He understood that efficient operations were paramount to profitability. This involved selecting appropriate property management software, establishing clear protocols for maintenance requests, and developing a streamlined process for rent collection. These operational efficiencies allowed him to scale his portfolio without becoming overwhelmed by day-to-day tasks. Central to his success in rental properties was the implementation of rigorous tenant screening best practices. Robert learned that a thorough screening process was the first line of defense against potential issues like property damage, late payments, and evictions. This included comprehensive background checks, credit score analysis, employment verification, and previous landlord references. According to industry data from TransUnion, thorough screening can reduce eviction rates by up to 50%, significantly impacting an investor's bottom line. Furthermore, Robert meticulously crafted legally sound lease agreements. These documents defined the rights and responsibilities of both landlord and tenant, covering everything from rent payment schedules and late fees to maintenance responsibilities and pet policies. Clear, unambiguous lease terms drafted with legal counsel minimized disputes and protected his interests, ensuring compliance with local housing laws and regulations. This proactive legal approach became a cornerstone of his rental strategy. Optimizing cash flow became Robert's primary financial objective. This involved careful rent setting informed by local market analysis and comparable rental rates and stringent expense management. He meticulously tracked all operational costs, from property taxes and insurance to maintenance and utilities, always seeking ways to enhance the cash-on-cash return. Cash-on-cash return measures the annual pre-tax cash flow an investor receives relative to the total cash invested, offering a clearer picture of immediate profitability than broader ROI. His understanding of key performance indicators fundamentally shifted. Where ROI, or return on investment, was once measured by the swift profit margin on a sale, Robert now focused on the consistent long-term cash flow and equity accumulation. He learned that a lower immediate cap rate might still be attractive if it offered strong long-term appreciation potential and reliable rental income, fundamentally altering his decision-making matrix. This investor mindset pivot was perhaps the most crucial element of his transformation. The market downturn, which initially crippled his flipping business, paradoxically created unprecedented opportunities for acquiring rental properties. Distressed assets, including foreclosures and properties from desperate sellers, became available at significantly reduced prices. Robert leveraged this buyer's market, strategically acquiring properties that, while requiring some renovation, offered strong potential for rental income and future appreciation. This demonstrated his ability to turn adversity into advantage. The power of long-term appreciation became a cornerstone of his new strategy. While flipping chased immediate price bumps, rental properties allowed him to capitalize on the slow, steady rise in property values over years, sometimes decades. This patient approach, combined with consistent rent collection, provided a dual pathway to wealth: passive income in the short term and substantial equity growth over the long haul. It was a profound shift from speculative trading to foundational asset building. Robert also became adept at leveraging the substantial tax advantages afforded to rental property owners. Depreciation, for instance, allowed him to deduct a portion of the property's value each year, reducing his taxable income. Furthermore, he learned about the 1031 exchange, a provision in the U.S. Internal Revenue Code that allows investors to defer capital gains taxes on the sale of an investment property if they reinvest the proceeds into a similar property within a specific time frame. This enabled him to continually grow his portfolio tax efficiently. Scaling his rental business necessitated building a reliable team. Robert understood he could not manage dozens of properties single-handedly. He cultivated relationships with trusted contractors for maintenance and repairs, engaged a professional property management company for day-to-day operations, and retained legal counsel for lease reviews and eviction processes. This delegation allowed him to focus on strategic growth and portfolio management rather than operational minutiae. Despite the inherent stability of rental properties, Robert remained acutely aware of potential risks. He proactively developed strategies for mitigating common challenges such as tenant vacancies, unexpected major repairs, and localized market downturns. Establishing an emergency fund for each property, maintaining comprehensive landlord insurance, and diversifying his portfolio across different neighborhoods or even property types became standard practice. This comprehensive risk assessment was vital. His journey led him to further diversification within his rental portfolio. Initially, he focused on single-family homes, but as his expertise grew, he explored duplexes, small multifamily units, and even commercial properties. This strategy, according to economic analyses by institutions like the National Association of Realtors, helps cushion against localized market fluctuations and provides multiple income streams, enhancing overall portfolio resilience and stability. Data remained at the heart of Robert's evolving investment decisions. He continuously monitored local economic indicators, rental demand trends, population growth, and job markets. Software tools for market analysis and property valuation became indispensable. His decisions were no longer based on gut feeling or market hype, but on verifiable data and calculated projections, enabling him to make informed choices about where and when to acquire new assets or optimize existing ones. Over time, Robert successfully scaled his rental business from a handful of properties to a substantial portfolio, generating significant passive income. This success story illustrates the profound impact of strategic adaptation and the power of long-term vision in real estate. His pivot was not merely a change in tactics, but a fundamental re-engineering of his entire investment philosophy, demonstrating resilience and foresight. The true meaning of passive income became tangible for Robert. It was no longer a theoretical concept, but a consistent, reliable stream of revenue that provided financial freedom and security. This income allowed him to reinvest, further grow his portfolio, and ultimately achieve a level of financial independence that house flipping, with its inherent volatility, could not sustainably offer. It was the realization of enduring wealth through tangible assets. The lessons from Robert Lee's pivot are clear and profound for any aspiring or current real estate investor. They underscore the importance of understanding market cycles, the necessity of a flexible investment strategy, and the enduring power of cash flow over speculative gains. His journey from the brink of financial distress to sustained success offers a powerful blueprint for navigating the complexities of the real estate market. As markets continue to evolve, the ability to adapt remains paramount. Robert Lee's story serves as a potent reminder that while quick profits can be alluring, true wealth in real estate is often built on the foundational principles of steady income, long-term equity, and strategic resilience. Understanding these dynamics is not just about surviving market shifts, it is about thriving within them.